Hi guys, how are you? I hope you guys are doing well. And on this video, I'm going to answer the question whether markets are going to go up. I'm reorganizing a lot of my portfolio, taking a lot of new bets, exploring a lot of markets. So a lot of research has gone into making this video. So I'm going to take you through a presentation and hopefully this will give you enough insights as to how to restructure your portfolio and accordingly you can plan. Okay. So now for people who don't have any patience, who want a quick answer, here are 3 key points that you should know. And here is the shorter version. But I would really encourage you to listen to the entire story, the entire presentation. It will be very useful for you, right? Because you will get conviction to invest. But here is the short version because I don't want to dangle you through like a 15-20 minute video. So in case you require like a short answer, here it is. So yes, in the short term, it looks likely that the markets are going to go up. The prime reason for this is that there is something called as one big beautiful bill. It has been passed in the US. In simple words, it's bringing a lot more liquidity into the market. So we can expect over the next, I don't know, X number of months for the markets to go up, right? But here is the point, right? That the counterbalance to this is that the markets have already started to go up. So there is a very high probability that liquidity has first come into the market before this news, right? So this is like up for debate. But yes, in the short term, it looks like that the channel, and I'll just put the channel here, that this channel will be achieved, right? So this is another 3-4% gain, and this is most likely that this will be accomplished. Now, over a mid-term, here the answer becomes a little bit more complex. I feel that the markets are going to give you 12-13% CAGR, the way it has been doing for the last 15-20 years in the Indian market. But the problem is that the real inflation in the Indian market or just generally across the globe is going to be high, right? So yes, the real money that you'll make from the markets is likely to go down on the midterm. I'll explain this complicated point. Third and finally, in the long term, only industries which are geared towards growth are going to generate returns. We will see less and less overall market returns. The index will be kept sideways, but specific industries will benefit. So here was the short answer. Now, if you're looking for a slightly lengthy data-driven answer, here is the answer and here is how I'll structure it. So basically, we can just go to first principles and think, why does a market go up? And there are 3 key reasons why a market would go up. So the first one is fundamental, that there is some kind of fundamental improvement in the market, or equities in general have been doing badly, so there will be a mean reversion and then the markets will go up because of that. The second key reason for a market to go up is technical. For example, consider this China index. Technically it looks strong because it has been consolidating for a while and there might be a breakout, right? So this is a technical reason. Now, do such technical reasons exist on Indian and US equities where majority of you guys might be investing money? So the short answer is no, that technically the market does not look sound, right? And I'll tell you why. Okay. Third point is that the markets go up due to sentiments, that sentimentally the markets might be like, oversold, right? Or maybe overbought. So if something is overbought, people are very bullish, then uske baad market is likely to go down, not up, right? Now this can also be judged on a short-term basis and this is called as market mood index. So here you will see the Indian market in the greed zone. Okay, so greed zone means that people are generally bullish about the market. So even sentimentally, it doesn't look great, but let me start discussing all 3 key points. And let's start with fundamentals because this is where many of us would fall, that we might be looking to put our money on 3-4 year, 5-year basis. And we want to invest in a fundamentally sound market, okay? And for this, right now, the most important concept that you should know is the relationship between the stock market and GDP. Now, there is a very strong correlation between the GDP growth of a country and its stock market. This is not applicable across the board. You cannot apply this principle for like Japan or China. But in India and the US, this correlation is very strong. Now, let me show this to you by taking you to historic data. So, for example, if you study the GDP versus the stock market growth on 1, 3, 5, 7, 10-year basis, you'll see that our GDP grew on a 1-year basis at 6.5% and the market has gone up by 15-20%. Okay. Then 3-year basis, you'll see 6.8% is the GDP CAGR and stock market is 12 to 14% and so on and so forth. Now you'll see, and let's pick an example. So let's look at the market on 3-year basis. The GDP is 6.8, but the stock market is 12-14%. See, 6.8 is the real GDP. Now, real GDP does not include inflation in it. Now, in India, the official rate of inflation, government typically tells us that, it's like 5% or something. Now, on 7-year basis, if you add 5, now again, that method matches up. 10-year basis, again that method matches up. But on 1-year basis, right, 1 year is really short term, right? So on 1-year basis, we can't really sort of predetermine correlation between like GDP and stock market, because usually what happens is that GDP is a lagging indicator. GDP means that, hey, this has happened. We have measured like all the data that our base or our nation grew at X%. And stock market is what? It's a leading indicator. So there can be a short-term discrepancy between the two. But long story short, we can definitely conclude from the slide that there is a very, very strong relationship between GDP and the stock market. Okay. And on a short-term basis, and this is another key takeaway that I'll give you, that on a 1 year / short-term basis, right now the GDP seems to be slow, but the stock market seems to be high. So this is not like good news in case you're looking to invest more money right now. Okay, so this is what GDP versus stock market data tells us. Now, this is not the only fundamental thing at play. What happens is that investors forecast what GDP is going to do in the future. So for example, right now, GDP is not doing that great. But people might be thinking that, you know what, boss, after like 3-4 years, 5 years, maybe GDP will accelerate really fast, right, over a 3-year period. So they are happy paying like a higher price for the stock market now. So is that really happening? So here are the forecast for world GDP and India GDP. So world forecast we'll see first. So you can see that the world GDP forecast that roughly lies around 2.5%. Okay, so this is not like exceptional growth in the year 2025 and 2026. Okay, so again, we cannot put like a very positive spin on GDP, right, at a world level. What about India? Now, this is very slow growth rate, right? So till 2026, we are expected not to have like any bumper growth rate, right? Now we keep on saying that, you know what, India is a major economy and is one of the highest for a large economy. That's true, but honestly, like for India to grow from a lower base, because our GDP per capita is very small, so it's trying to grow from a lower base, right? So this 6.5% figure is not optimistic, okay, from an investor's lens. So therefore, I would say that, hey, it is fair to conclude that, hey, over a 3-year period, expecting that 12-13% CAGR is a baseline moderate scenario. Now, GDP is not the only thing that impacts the fundamentals of the stock market. There are other things at play, especially like some major news items. So let me just take you through that very quickly. So the first was Iran and Israel war. So this had been going on, and what has happened with Iran-Israel war is that a ceasefire has been reached. Now, in case the ceasefire is broken and the war starts again, unless it doesn't blow into like a nuclear war, it seems that there is hardly going to be any impact due to Iran-Israel war. Now, this also has to do with the fact that the same piece of news will not impact the stock market negatively multiple times. Okay. Now, whatever spookiness was there around Iran-Israel war, that has been taken care of, and I don't think it's going to have like any more impact from that perspective unless it goes nuclear or like, you know, it becomes like aggravated from this point. Okay. The second key point, this is more important, that there is more liquidity in the market, and this has happened due to two reasons. One is that in India, you would have seen that RBI has cut the interest rates and they have lowered the CRR or cash reserve ratio for banks. What in simple word it does is that it pushes like more money into the economy. Now, let's say that instead of having like 100 units of money with the banks now they might have like, let's say 110 units of money due to lower CRR requirements. So banks will give out more loans, people will borrow more, rate of borrowing has come down. For example, you might be reading the news that, hey, you know what, due to interest rate cuts, the home loan EMI has been lowered, right? So your EMI payments on home loans, that has come down. Now, all that brings more money into the market. Now, if we take a step further, right, and if we look at it from a macro lens, now all this money flow actually starts from the US. Now, many of you will get really pissed that, you know, how like US impacts India. That almost 60-70% of Forex trade that happens, right, happens in US dollars. So therefore, US, whatever macro steps it's taking, it's going to create a ripple effect on the world's economy, and it also hits India. Okay. So in the US, something has happened and it's called as One Big Beautiful Bill. In very simple language, what One Big Beautiful Bill does is that it brings in more money into the US markets. And if they borrow, they are going to do more expenditure and more money is going to come into the economy. So in simple words, liquidity increases dramatically. Now, here is the beauty that if you check, right, and here is the chart, right, so if you will check, right, that from the trade war lows in March, Indian index has gone up by roughly 16%. Now, something similar has happened on QQQ, right, and S&P 500 and all the other indices. Now, why? Because this One Big Beautiful Bill or the government printing more money, this was being anticipated. So this brings me to the third point on the slide. It says that, hey, liquidity shock. That liquidities flows, then stock market rises. So this is one way liquidity shock kind of works, that, okay, a bill is announced and then people start thinking, acha, you know what, now more money will come. or people just anticipate that, okay, this bill is going to pass and it will definitely pass. So more money comes into the stock market dramatically. Okay, so what has happened this time is that the impact of one big beautiful bill going forward now, it's not going to be that much, but people had already anticipated that more liquidity is going to come. So the stock market has already gone up, right? So this is the bottom line. Okay, then we will see more news like going forward that, China and US, their trade issues have been solved, and whatever breakup they were on, that has been solved. And similarly, like, Donald Trump is going to like give out like some good news and, marketing around it quite dramatically around these trade war deals. And that's going to just push up the market a little bit more, right? Now, bond market is in a crisis. You might be hearing like a lot of commentators, they are saying that, at bond market, like there are a lot of issues going on and the world is going to collapse. Ray Dalio, for example, has been speaking negatively. You would be seeing like people like Robert Kiyosaki who have been speaking very negatively about the market, that just buy gold and Bitcoin or whatever and do not buy anything else. I think all that is like a little bit of fear mongering, right? And honestly, like, those guys are not bad people per se, but the points that they speak from their portfolio. They have like billions of dollars to invest. We don't. So for us, it doesn't matter, right? For us, what matters is that are we getting stocks at like reasonable prices? We don't have to move like billions of dollars. For us, investing like small ticket amounts is not that big a challenge, even in a slightly overvalued market. Okay, so fundamentally, how would I put things together? So I will show you like 3 more slides and then I'll conclude this. See, the first key slide is that all this excess money coming into the market, on a long-term basis, it's not great, okay? And here is a research paper that was done by Yale, and here are 7 key takeaways that have been written from that paper. And basically what they are simply saying is that, see, this one big beautiful bill, more money coming into the market, US debt going up, this is not great news on a long-term basis. It makes economy fragile over a longer term. And more importantly, it structurally slows down the rate of growth of the world. This is what they are projecting on a long-term basis. Do I agree with this? No, and I'll explain you my reason. I'm not trying to go against Yale, but this is my viewpoint and I am entitled to my viewpoint. I'll explain you, but I wanted to set the context that, see, you have to see the market fundamentally over a time horizon. So long term, this is what Yale is saying. Now, on a mid-term and short-term, they have not done much commentary, but we can understand the mid-term and short-term sentiments by the data that I had already shown you, which is the GDP expectation or GDP forecast data. So from that, it looks neutral. It doesn't look amazing, like, the fundamentals, and long-term, it looks weak. This is what the fundamental data tells us, okay? And just to kind of put that in perspective, right? So this is what the Yale study has pointed out to, that there is going to be a change in real GDP and you can see it falling, right? The GDP growth rate, and they are projecting even negative numbers. Is this going to work out? I don't think so, right? This is like fear mongering as per me. I'll explain that in a minute. Second key point that they are explaining is that, see, boss, the treasury yields or the bond yields are going to increase on the markets. Now, this is going to have 2 impacts, right? One is that if the bond yield goes up like this, right, what you're seeing on your chart, what this means is that the cost of borrowing for businesses is going up. For example, if you run like a small business in India, your rate of borrowing right now is 10%. Okay, so you're borrowing money at 10% rate. Now, if structurally the interest rates are going up or bond yields are going up, then what is going to happen? Well, you're going to get those loans at a much more pricey point. So instead of paying like 10%, you might now be expected to pay like 14%, 15%. So the cost of borrowing goes up. Okay, so this is like a genuine problem. This I agree with. Okay, so this is one. Now, second key thing is, and this is what people need to read between the lines, that, see, if the rate of borrowing is going up, it's generally bad for the economy, no doubt. There are certain industries which are winner takes all kind of markets, right? For example, tech, because they are free cash flows companies. Yes, their capex cycle, R&D investments go down, right, when they have to borrow like at a crazy rate. But typically they don't borrow that much money when the interest rates are high. They would typically borrow when interest rates are low. Okay, so yes, I do agree with this chart that over a long term, right, the yields are going up. Borrowing is going to become bad, right, for general industries. This is going to have a lot more impact on small cap, mid cap stocks. Okay, so we need to be a little bit careful over a longer term. If you're a buy and forget type of investor, stay away from small cap, mid cap. But there is hope. Okay, so the hope is, and here I'm putting like Cathie Wood's photo. So people who don't know who Cathie Wood is, so she's like a very celebrated investor in the US. Unfortunately, she has lost a lot of money, but she has had some interesting points, right? And I'll just kind of summarize it for you. Her quotation is that growth creates deflation. Now, what is the meaning of that? Well, okay, so let's consider like artificial intelligence. Now, if you look at companies like Tesla, they are building robo taxis. Long story short, with artificial intelligence, you can improve productivity. How exactly? Because a robo-taxi can work like 24/7 almost, and almost infinite amount of cars can be created. That will do what? Well, that will reduce your cost of travel. Why? Because you don't have to employ any human labor. Okay, and instead of, let's say, total 1,000 hours of taxi driving time in the country, now we will be able to 10x, 20x that. Now, what does that lead to? Well, it leads to price cut on taxi rides. So growth basically creates deflation. This is a beautiful point, and I agree with this. This is going to happen a lot, right? Across a lot of industries, right from like manufacturing, right from robo-taxis, right from computational power, right from drone delivery, all these different things, right? So as a fundamental investor, what should you do? And this is my takeaway, and you should invest in growth. Okay, you should invest in companies that are actually leading the growth engines. So you would have been seeing me, like, since like February, March, I have been speaking quite a lot about like US stocks. This is the reason why, right? Because honestly, like the more I read about this stuff, the more I'm convinced that it kind of makes sense to divert a lot of your portfolio to growth companies, secular growth companies, right? I mean, fine. If you can find those companies in India, great. Okay, this is two. Third, see, growth does not come without volatility. There is a lot of fluctuation that's happening. For example, in 2021, 2022, Meta or Facebook corrected by 70-78%. Okay, after that, Amazon also corrected by 30-40%. Long story short, these are trillion-dollar companies and they are going down like Bitcoin. Okay, so what does that lead to? Well, it leads to a lot of volatility. Volatility ka matlab that it goes up and down, up and down. Okay, so you should kind of take money off the table when the charts are telling you. Okay, so this is what my viewpoint on fundamentals would be if I have to quickly summarize it. Short term, we might just hit this channel, what I had shown you earlier. Long-term prospects are kind of, there is a thesis and antithesis. The thesis is that, okay, Cathy Wood saying that, you know what, growth can create deflation. So yes, but you as a stock market investor will only make money if you are investing in growth industries. If you just generally invest in index, it's not going to work out because volatility is going to make you panic. And yeah, so it's very important to take money off the table. Okay, so this is what I'll leave you with. Okay, now let's analyze the second pillar, that from a market point of view, is the market going to go up, down? What do technicals tell us? Okay, so here is the most important chart that I will show you. And the chart is that if you take a look at PE ratio, okay, from 2021, 2022, 3, 4, 5, we get like a very rich data set. Okay, and what it tells you is, and here is, I have highlighted this, that whenever the Nifty PE crosses 22, subsequent 3-year returns tend to be muted or negative. And this is kind of true, and therefore I am again pointing you out to this chart that I believe that we are going to trade in this channel. Okay, so this is a channel trading technique that you can use. The upside seems to be whatever, like 3-4%, right? And at that point in time, you should book some profits. If you try to see if you are able to buy a support, definitely do it. But technically, there is no pattern that is forming that kind of indicates that, you know what, okay, we are in like some great technical breakout thing. Now, does that mean that a technical breakout cannot happen? It can, right? Technicals work that way sometimes. But long story short, there is no reason that we can figure out right now that why a massive breakout will happen. The markets are generally slightly overvalued. This is a fact. Now, the second key thing is that there is a very important psychological pivot level of 25,000. So I had said it earlier also, since January, I've been saying that in 2025, we are going to move in that 10% range, right? Around 25. So between 22,500 to 27,500, that is the range. Okay, so in which we are going to move. And this 25K is a very important psychological level, and the technical analysis also tells us the same. Most important thing to notice that if you take a look at 2021 June, right? So you were at 29 P, okay, 29 P. And post that, there was an earnings contraction also. And then the P corrected quite a lot, right? By 2022 June, the P had dropped to 19. So there was a big PE contraction that happened in this 2021 to 2022 phase. What you should do from a technical point of view is that have some money on the sidelines. It's absolutely critical, because if you could not buy dips like 2022 June, right, where the PE of the market was 19.67, you'll not make any money over the next 10 years, okay? Unless you buy the market cheap, you're not going to make money. This is what the basics of technical is. So please keep this in mind. This is absolutely important. So, okay, so fundamentally, we are okay. We are not that great, but honestly, trading the channel kind of makes sense. What about sentimentally? Okay, so sentimentally, see, so we are very short-term thinkers. So sentimentally, I have already shown you like the market mood index On an absolute short-term basis, there is greed. So there is no kind of like, bullishness in terms of buying. What you can buy is some beaten down industries. For example, right now I'm adding more IT stocks in India. They have been badly beaten down. I am buying secular tech companies, right? Healthcare in the US is badly beaten down. So I'm adding all these different things. Sentiment wise, you have to be very sector specific, right? At a market level, the sentiment seems too bullish right now, right? Both the Indian market and the US market are slightly overvalued. So long story short, right, that is the market overvalued? Yes. Should you be adding more? At a market level, no. At an index level, no. At a sectoral level, yes. If you're a long-term investor, what is it that you should be doing? Well, you should be buying growth companies, right? So this is precisely what I'd be doing. In case you guys are interested, I do run a portfolio where I literally teach you how to build a portfolio from scratch. All those different points. Every month, I'm investing close to $100,000 in that portfolio. So in case you are interested, you can definitely join that community. I'm putting the links in the description comment box. Thank you so much for watching, and I'll see you soon.